to our a very warm welcome to our investors workshop. Today, the first one which we're holding in a hybrid format. So we have people here in Berlin at our host, Berlin partner, and we have people from around the world, as I see, who've joined us online. My name is Oliver Hasse. I'm the managing director of INAM, and before we dive into the subject matter, I would quickly run you through what we actually do at INAM. And that is basically bring together players in the field of advanced materials to enable innovation and to bring products to the market. In our ecosystem, which we've been building since 2016, we have corporates, small and medium enterprises, of course, startups, investors, and last but not least, research institutions, which all contribute to this main purpose. We have built an ecosystem around three main startup programs that we have. One is an incubation program, which is targeting very early stage startups and is giving them a stipend for a year and access to labs to be able to validate their products, to develop them further, and to move on to the pilot phase. Our main and first program has been the Advanced Materials Competition, usually held once a year, and that's targeting startups which are around piloting with industry, usually a bit before that. Also this year, we're going to introduce your Advanced Materials Scale Acceleration Program, which is then again focusing on startups which are in growth mode, i.e. that want to raise the first structured funding round and or want to scale, i.e. they have done their piloting, they have their industry partners, they have had paying customers, and now they want to grow. Around these programs, we have accumulated partners and members that support us. Of course, we have our corporate members, most importantly, that support the association that INAM is, but also our startups in oftentimes doing joint projects. We have our research and co-working partners and members. We're supported, as we are today, by government and institutions that are close to government, including Berlin Partner. And we have, as of late, assembled a set of investment partners. And finally, also, one of our founding members has been right now legal advisors, which have actually made contact to today's speaker. And I'm very grateful for that. That we have today here Kreske Nickelson, a long-standing advisor to German VCs and investor, and also managing director of her own corporate finance boutique. Besides Kreske Nickelson, we also have here Alexander Herman, who's been working together with Kreske Nickelson for his own startup, Brand Perspectives, which is in the sensor business, and more particularly in the business of leakage detection for chemical production plants and sites. And without further much ado, I'd like to ask on stage Kreske Nickelson. Thank you very much to join us today, Kreske. It's a pleasure, and I'm really curious to hear more about asset finance.
This one thing we've got going here. There we go.
Okay, well, thank you very much for having me. As I said, my name is Kreske Nickelson. I've been doing venture capital funding for the last, well, many years, since I joined 3i in London, actually, in '98, worked out of London for 6-7 years, then Amsterdam, then Warsaw, now Basel at Kineo. So I've done basically a tour around Germany with my different jobs, but I've been doing early stage startup funding, equity as well as debt funding now with Kineo for the majority of my working life. So here we go. What we do at Kineo is something, at least in the European ecosystem, nobody else really does, because we do debt financing solutions, the majority of debt finance solutions for hardware startups. And where that comes from is because we're all ex-VCs, and we're all coming from a VC world in which companies have taken a bit too long, actually, in their development, and have taken a bit too much money, so that investors at the time of the product being ready and the market about to be conquered, they say, you know what, we're not going to give you any more money. So if you need more money, you need to generate revenues and you need to build your own business, because we don't want to give you any more money. We want money back as of now. So go and sell your hardware. It's not that easy, as most hardware people know. So what we developed, actually, how do I do this? Down? Down. I can't do down.
Oh, sorry. If you just go to the
No, doesn't work. Sorry. Nothing I can do. Here we go. What did you do?
Up and down.
Up and down.
There we go.
Now it works. Okay, cool. So what we've developed is a product to do structured debt financing, actually, for hardware-related startups. And legally, we structure this as lease financing. So at least in Germany, we're BaFin regulated. It's nothing you can just do as a venture capital fund, but you need to jump through quite a lot of loops, actually, go through some regulatory approval process. Took us about 2 years to get the approval in place, but now here we are. So what we can do is we're a Swiss AG, not a fund. We're just a normal AG business. We have a German subsidiary and an American subsidiary. So global is a big word, but what we can do is we can support companies definitely all over Western Europe and North America. And other parts of the world we can do on a case-by-case basis, but where then we have to look a bit more closely on local regulatory requirements on what we do. We support companies, as I said, who don't want to just sell hardware, which is lumpy and often a budget sale and sometimes really not very satisfactory to all parties, but they just want to sell information, data analytics, and actually a service program. And most customers, if you're honest, are not interested in a piece of hardware. They're interested in information and they're interested in a service. But to collect the data, which are necessary to provide information, you need some hardware. And that's what we fund, because basically the hardware in those instances, I always call it, it's like a Trojan horse for the supplier, right? So you're saying, well, you have to have the hardware for us to push through our services into your company or into your business. And most partners or customers are quite happy to do that, because they're not, as long as somebody else is financing the hardware, they're fine. Actually, they just want the service and the access to the information. So what we do, we offer asset-backed lending to companies in certain volumes. I start as of a volume of a total framework agreement volume of 5 million. I'm going to come to that later. And these companies who want to commercialize their hardware in pay-per-use models, in hardware as a service models, in subscription models, and do not want to sell the hardware for the reasons I said before, because it's lumpy, because it's often a budget sale, because hardware is expensive, and because a company or a potential customer interested in a new piece of, or in a new service, or even in a new piece of hardware, they do not want to upfront pay 500,000 for hardware, which has never been really proven in the market, and which they haven't been able to test and try. So what they're trying to do, what they're trying to say is, well, can I have a test phase? Can I have a rent phase? Can you give it to me for free to start with? I don't want to pay for it. Or they say, come back in 18 months once I've got a budget for it, and so on. So what we can do and what we enable these companies is we enable accelerated market access, because you don't have to sell hardware anymore, which is cool for most companies. So they can just say, you don't need to buy it. I will just place it here, and I need the data generated by the hardware to enable my service, but you don't need to pay for it. Most customers like that. And they can actually get a better relationship going with their customers, because normally when you have these service business models well implemented and it's going really well on a B2B scale, most businesses don't mess around with a running system. So by the time these solutions are up and running and it's actually working for everybody, these contracts are quite sticky and they're prolonged. And for the company offering the service, it's most of the time more profitable to offer the hardware as a service than to just sell it and hope that the customer is going to come back for a next update eventually, maybe. Venture capital companies don't mind working with us because we have a very light securitization, as I said. We're not like normal debt on the balance sheet, but at least under German HGB and in some other accounting systems, we can be booked as revenue. So we're sort of off balance sheet in a sense that the company is selling hardware to us and we lease the hardware back. So we basically lease back the commercial use of the hardware while giving cash alongside as a loan. This works really well for high margin businesses. So if you're operating on a 2% margin, it's not going to work. But if you're operating on with new technology on a 30, 40, 50, 60% margin, which can happen, then it works really well because the loan bit is just smoothing cash flow requirements. So we give out the cash as a loan and the loan is being repaid in an agreed upon schedule. But our interest rate sticks and therefore the margin needs to allow for the interest rate to actually be in between and increase cost of goods eventually. The venture capital investors like us because we are leveraged. We're leveraged on venture capital, which normally you can't get in venture funded businesses. So we're accelerating market entry and we leverage the equity, thus improving multiples on exit. And in supplying working capital into the system, third benefit is that there's less dilution for founders and less dilution for old investors because they don't need to raise yet another round of capital. And if you raise venture capital, you know that it will cost you 30 to 50%, whether you like it or not, because it's nothing, it's no immediate cash out, admittedly, but it's easily 30% plus. And that's how you calculate your equity rounds, at least as an investor. So, and the last bit, especially for American customers, is that you can convert CapEx into OpEx. And especially the Americans like that very much because they hate having CapEx on the balance sheet. And what it's nice as well is in these IoT business models, you can transform a hardware heavy company into a software business because we take all the hardware off the balance sheet, which means the balance sheet becomes quite short. And that business can then be sold on a software multiple, which is an added benefit in certain circumstances because software multiples tend to be higher for venture-backed companies than the others. So most of it, I said before, without companies are left with selling hardware, which can work, but it's slow and lumpy and not sustainable necessarily. And with us, you can provide hardware as a service. We are not a solution for every problem, admittedly, right? So, and we do charge interest rates, so we're not a charity. But what we can do is we can help companies getting through this market entry crunch when nobody is yet knowing how this is going to go. And we grow with the business. So we're not a loan which says, well, here you have 5 million and you have to pay for it, whether you like it or not, and whether you need the money or not. But we can grow with the business. It's more like, in terms of functionality, it's more like a line the company dips into whenever there's a paying customer. So let's say, and Alexander's going to talk about it with Grand Perspective, but once there is a service agreement with a customer, they can turn to us, we buy the hardware, and then can then provide the hardware as a service to the customer and start paying for the loan only once there is actually a customer as well in the loop, which means we're growing with the business step by step, but the exposure of the company to the loan portion grows in line with the revenue increase. So we don't destabilize companies. Well, in an ideal world, we don't. Yeah, so if it's structured well, we're supporting growth, but we're not stuffing money into a business which may or may not be able to serve the debt. So this is how it works. The company has a customer, right? The company has, well, no, to start with, the company and we sign a framework agreement. This framework agreement says we keep in store for you this amount of money at that interest rate. Maybe there are some warrants in the mix. The lease payment period, so the duration of the loan is going to be 3 years, 4 years, 5 years, 6 years, and we're going to buy assets for this and this amount. So it's cost of goods, or it's cost of goods plus, or is whatever, all of that is pre-negotiated. And then the sales force can go out and sell service agreements. Once then there is a customer who's interested in a service agreement, and the company can actually sell these service agreements on these predefined terms because they know what they have to pay to us. So they have the security through the framework agreement. They can then, as I said before, turn around, sell us the asset. We pay normally within 2 days. So the company gets cash and can start the service agreement with the customer. That is in its simplest form. Initially, it takes a few days to get this cycle up and running once we have a framework agreement. But once it's really in place, normally the sale and leaseback process takes less than a week in print. So it becomes very easy from an operational point of view, because we have standard agreements, all pre-negotiated, and we just need to execute those. Use cases. So where do we operate? Medical devices, reagent rental models, obviously. Logistics, IoT is growing really heavily at the moment. So all these, a single sensor box, let's say, is not that expensive, right? So it might have costs of 4,000, 5,000, 6,000 euros. But if you then multiply it by, I don't know, 80,000, let's say, it's a lot of money, which neither customers nor the companies are prepared to pay for. So we take those. We have quite a lot of those agreements. And we do robotics, logistics, 3D printing. Those businesses are growing as well. So last week I looked, for example, at a drone which can pick apples. So we have apple picking drones, we've got logistics robots, we've got robotic arms fulfilling single item orders. We've got the IoT company putting sensor boxes on every single wagon of Deutsche Bahn. And in the medical device space, we go from diagnostic readers to NMR machines. So it's quite a wide range of things we're financing. What we need, the two constant things we need is we need hardware. I always say we need hardware with a serial number on it, because otherwise we're not allowed to give out the money. We're not a bank. And we need a customer in some service arrangement. And the rest, yeah, we're not 100% flexible, but we're pretty flexible in terms of trying to adjust to the business model the company decides upon. There's a few use cases. As I said, Nexia is the IoT company putting boxes on railway wagons. Brand Perspective is here. These are all companies who actually issued a press release, so I'm allowed to talk about them. We've got 26 in total. Some prefer to keep us quiet, and then we honor that, so we don't issue our own press releases, which is why these are the ones I can talk about. But as you see, it goes from logistics over medical devices, security, robots, 3D printers, smart storage. It's a full range of stuff we're looking at. And that's us at a glance, really. We've been around for 6 years now, 26 investments made. So far, they've all gone well, so we haven't written off anything, which is good. We're an AG, a Swiss AG, meaning we're not a fund, so we're not on a timeline, having to get money back in a certain time frame or having to invest in a certain time frame. Patient capital. Our AG Foundation is the one investor we can talk about. We've got leasing knowledge on board, we've got venture capital knowledge on board, and we're happy to do business in all kinds of areas. which is why I'm here actually, try to present it to you, because we're still educating the market on, yes, we're here, we're around, we've put money, and we're happy to buy hardware. Here we go. I think that's it. That's the team, 14 people in total. Yeah, we can do anything from, as I said, sensor panels to my colleague in the US, Chuck Selman. He used to be a pilot, and he used to do ship turbines and aircraft carriers and stuff like that. So we can do the very small stuff, but we can go quite big on complicated structured finances as well. And that's it. That's us. Here we go.
Thank you very much. Are there any questions from the audience, offline or online, at this stage? I would, if not, I would, after the next presentation, invite people to ask their question in a Q&A round. So we'll do that. I also have my question.
Yeah.
But then, thank you very much, Kreske.
Here we go.
For the time being, back on stage after the presentation from Alexander Herman of Brand Perspective. So to say, a use case or a case study for the finance.
Right. Yeah, thank you very much for having us. Thank you very much for the short introduction. As indicated earlier, we are one use case of asset financing by Kineo. So I'm very happy to present our company here. And then, of course, I will try to highlight these, let's say, benefits of having the asset financing. And what's our benefit? What's the benefit of our customers? I don't know if we can start with the presentation so far.
Yeah, just move forward.
Just press down.
Du musst im Pfeil runter, genau.
Oh, okay, great. Mm-hmm.
There we go.
Okay, so Brand Perspective, that's the name of the company, and it is all about a holistic emission monitoring system called ScanFed. And actually, as you will learn later, this is provided to our customers as a monitoring as a service business model. So, I mean, as you may know, a chemical plant, a typical chemical plant uses thousands of tons of hazardous, environmentally harmful gases every day. That's very typical to those industries. And we've learned that about 69% of significant emissions of those gases are not detected today. And this may lead to major incidents. But let's say in any case, it is in strong contrast with the zero emission goals of today's industries. For instance, as provided or promoted also by the EU of today. So that was the background why we created ScanFed. And as you can see here in that slide, it starts with a hardware to enable our services. So the hardware is a remote sensing hardware solution, you can say, that monitors all emissions in a plant in real time. It's about an optical chemical analysis working up to distances of 1 kilometer or more. And so the unique issue is that these sensors are able to locate, identify, and quantify gases at the same time. And as of today, we can do that for more than 400 compounds at the same time. But it's not only about the hardware, it's also about the software. But as you can imagine, this is a quite valuable hardware. And this was also, let's say, the point where we thought, okay, we have to provide our customers with that unique pieces in order to deliver our services, why not looking for a financing partner like Kineo, who's enabling that? And actually, we were looking around and talking to classical leasing partners, but as a startup company, no one was really willing to finance such an extraordinary and still risky business. So we were very lucky when we met with Kineo about 3 years ago, and then we learned that it might be a very good fit with what we are going to do. So, but let's talk about the system. As I said, we provide the monitoring as a service that by means of a permanent monitoring. So we are going to install these sensor units in high places at our customer site. Then on site, they are continuously scanning all the critical infrastructure, and they are promoting a real-time guest identification and quantification, as I said. And so in scientific means that means that we are generating millions of spectra about the atmosphere on site, and these data are going into a into a real-time database every day. And based on that, we are able to identify, quantify, and locate these many different substances. And for a customer, like for the first responders, for instance, it looks like that our software is generating automatic alarms in case of a hazardous emission. So here you can see how, let's say, the data produced by our hardware are finally generated and let's say offered to the customer in a very easy and in a very easy way. So here on the left hand side, you can see those emissions, and you can see here at the bottom also in the signal for an alert, where at the same time we are able to trace clouds when they are distributed through the site, through the campus, or whenever someone is endangered. At the same time, for the maintenance people in the factory, we provide maps of all leakages which we automatically detect. So our plans are to combine this with augmented reality solutions in the future as well, so that people get a very easy to understand overview of all the leakages on site. And as a third use case, we are generating automatically emission reports for the whole plant, for the whole site. So that means whenever by regulations, by upcoming regulations, the companies are required to provide reports every month, every quarter. They don't need to go outside and measure these emissions by hand and then write it down by hand to make a report. So this is all automatically provided by our system. And this is, to give an example, one of our leading customer use cases is the so-called Camelot Industrial Park in the Netherlands. We are providing, as I said, an autonomous permanent monitoring for a very large area of up to 2 kilometers, square kilometers. And so there are different companies on site. They are sharing our system, and actually they are very happy with that. This is how it looks like. Finally, you always have this kind of mixture between a video image and the measurement data. It's automatically scanning, and by doing this, covering large areas inside the plant. So finally, it's triggering automatic alarms. Here you can see another example for the user interface. And this is how it looks like when a leak was detected and displayed over a certain period of time. So this is just to make sure this is not a big leak. This is finally very small, but over time it's emitting a lot of tons of gases. So, and this is something you would not notice without this technique. So people are very impressed when they see our system. They do not believe that this is something they didn't realize before, that those emissions have been there all over the time, but they didn't know about it. So this is a little bit more about how to quantify the amounts. Of course, whenever we detect something, then it's important that we quantify those data in order to let the customer prioritize which leakage he's going to fix first and what's the next and so on. But the customer also needs to make their own, let's say, reports and define how much emissions they were able to reduce over a certain time. So they, with our system, they can really quantify the reduction of their emissions that they have achieved. So the whole system is fully integrated in the customer's hardware solution. This is also a very important point, that we are providing a very secure solution in industrial environment. So finally, to sum up, it's the Scanpad system, as we call it. It's the world's most advanced emission monitoring solution. And as I have shown you in some examples, it is very fast. It is a 24/7 solution. It has a very large coverage, and it is very precise. And at the same time, based on our software solutions, it is an easy to scale solution. It is intuitive and very powerful. And so when we started, for the founders, it was clear from the beginning that that our product has to be more than just hardware. So we very early we figured out that the uniqueness, the benefit of the system comes with the software and with the service we are providing. And therefore we decided to have the whole system, let's say, leased to the customer. The monitoring is a service solution. That means the customer does not need to buy the hardware. So he's just subscribing to the service on a monthly basis. And so we go there, we install the hardware, the customer gets access to the software. Finally, we also provide the hardware and everything which is necessary to have it, to have the system working in a very reliable way. And yeah, in order to finance that, we are selling the hardware to Kineo, as earlier pointed out by Kreske. Then it is leased back to Brand Perspective, and we are then leasing the whole system, hardware, software, and the services to the customer. And that makes it very easy for every customer. So they don't have to care about all the issues related to hardware. They don't need experts any longer who are able to service the hardware, or also to program the hardware or whatsoever. So that is enabled by the unique business model, and this comes with a financing model finally. And actually, we believe that this is also the future for those systems. And for us as a company, it means that we can use every budget we have for operating expenditures in order to improve our services. We don't have to care about the cost of the hardware finally. Of course, it has to refinance by means of our customer recurring fees. But as Kreske said, whenever we talk about a high margin business, which it is in our case, then for us it is also feasible to pay the financing costs associated to that. So we believe that the emission monitoring market is a very strong growing market, and so the demand is expected to increase up to more than $30 billion per year by 28, with a strong growth between 5 to 8%, mainly driven by the increasing regulations and also public awareness for safety and sustainability. Today, every chemical company has to think about how to become net zero, how to reduce emissions. And for us, it means that we are going to apply our system to different market segments, not only to the chemical industry, but also to the industry of power generation, also to transport and storages. And as our system is able to detect many substances at the same time, so I said earlier, we are able to measure more than 400 compounds. So it's not only limited to one substance like ammonia or to oil and gas, so we can serve all these different kinds of gases, of compounds at the same time with the different applications, which I explained, like safety, maintenance, and total emission measurement. And yeah, we have a very nice team, of course. And so the majority of our people comes from the software development, actually from all over the world. And we are very happy that we have been able to create this team over the last years. So today we provide safety maybe to the chemical industry, as I said, but we believe that based on the data we are creating every day, it will become much more. So tomorrow we harvest the biggest emission monitoring database in the world. This enabling, let's say, different kinds of services. Whenever a question comes up regarding emissions, so we are going to answer those questions based on our database. And that's it. Thank you so much.
Thank you very much. I think we all have a couple of questions, the positive meaning of this. And Kreske, you can join us. I start with a couple of questions about the grant perspective for us here. So if we assemble around the table. Now, if we look at your hardware, is that off the shelf, or do you buy components and assemble them, or how does it work? Or
yeah. So first of all, the whole design of the hardware is proprietary, and so that's defined by our engineers. But of course, we do purchase certain components from third parties, or we have customized parts, let's say, purchased from manufacturers, and all these are going to be assembled in-house. So we have a very unique piece of hardware.
Okay. So you don't produce as such.
I mean, it's kind of production. But it's more assembly than manufacturing every single piece. You're right.
Okay, and the core of the hardware system is basically your innovation, bringing together all the different components and the IT backend.
Absolutely, that's the whole combination. So it comprises a lot of optical know-how about how to process those optical data. It comes with the hardware, and then finally with the software we have developed over time.
Okay. And at which stage of the company did you start to talk to Kreske and or look? Well, I guess the first step was you looked around for financing and discovered that there are not so many VCs actually wanting to go into this type of financing or this type of business case. When you came then across Kreske.
I would say that our business model, or the business itself, was interesting to VCs from the first, from the very beginning. But however, we have the development budget on the one side, and in addition, we have to cover the hardware business, the hardware cost. So we started thinking about how to solve this problem, let's say, how to reduce funding budgets. And then I think based on a recommendation by some friend, we ended up with Kineo. And then from the first moment, we thought, wow, that's the best fit we can have. And So I think there are many things which we face every day. For instance, that our customers are worldwide located, so we have to put our hardware to every place. So if you will talk to a typical lease financing companies, they don't do that. So but they will ask you, okay, is it German? Is it purely focusing on Germany? But if you say no, it can also be in Africa or in Asia, they will immediately say, okay, then please look for another party. So.
Okay, yeah.
But we started talking before the first customer was on board, actually.
Okay.
So
Okay,
what
so
we
quite
normally
okay.
do is we do framework agreements early on, because otherwise the sales force has no security.
Yeah.
Right. So what we did in this case as well, we had everything up and running in terms of internal refinancing terms and mechanism before first customers were approached. Right?
Okay, that is very interesting to know, as a matter of fact, because you know, my question was kind of towards where you're in a scaling phase. You have those customers in Germany, but then you know you need to go beyond and produce more, which obviously requires finance.
No system's been sold so far, I think. Right? Have you sold systems?
We've never sold systems. So
Okay.
of course, our customers they ask, okay, are you also going to sell this? But then we say, okay, you know what? The best thing we can do is provide you the entire service, and then they get convinced, and finally they're happy. So no one, once they have used the service, they will not ask you for selling the hardware.
Okay.
Yeah. Then you were already mentioning that you're doing framework agreements before the first financing is done. So for you internally, that also means that you have to talk to your financiers whether they would want to.
We're an AG actually. We're just a normal operational business. So we allocate the money as we see fit.
Okay, so
we don't need to ask investors. No, that's done. They've invested. We have equity. We've got obviously some debt as well, but we can deploy it as we see fit.
Okay.
So we're very easy in terms of decision making.
Yeah.
We're 4 people and we decide, and that's it.
That of course is very easy. How then is the framework negotiation contract formation process? Does that involve a lot of classic due diligence work, or is it?
It's quite similar to equity, I'd say, or at least from my point of view. So from term sheet to final agreement, it's normally about 3 months, roundabout. I think we were maybe a bit faster, but it takes around 3 months.
Yeah.
And you can take from first talk to term sheet, it can take however long it takes. So sometimes we start talking to companies which are still in prototyping. Yeah. That's too early, admittedly. So when they have like a running, let's say a pilot, which is running well, or they already have an approved product, or they're going into their first serial production, and then so go to market is within the next, let's say, 6 to 12 months. That's when we start with a term sheet and then framework agreement. So as I said before, so to be for the company actually to have the security that they can actually offer services if they want to.
Yeah. Your interest rates are fixed, you've mentioned before?
They're not fixed, no.
Okay.
Well, we have different models. So yes, we do charge interest. As I said, we're not a charity. But what we do is we have different mechanisms of charging. So we can have pay-per-use models where we have a base rate and then we fluctuate with cash flows. We can have annuity type interests. We can have slightly lower interest and therefore some more warrants, or we can have less warrants or no warrants and therefore some higher interest. So there is, but the range is fixed. We're operating, and that's not a secret, we're operating mezzanine range to 12 to 15% total. Yeah. But I mean, Alexander can say that as well, we don't have hidden fees. So when we put a number on the front page and say this is what we're going to charge, that's it. So there's nothing.
Complete transparency. So
absolutely, yeah.
Makes it very
as Kreske said, it's really a very easy to work with on a daily basis, and that is what makes it so successful for me.
In terms of equity, we talk about ticket size or something like that. Is sort of there a minimum threshold that you would want to see covered?
Yes. So total So minimum total deal volume is 5 million, which means, but our framework agreements run over 10 years. So it's minimum of 5 million over a theoretical period of 10 years. So it's not very onerous.
No.
We need minimum volumes because we don't charge due diligence or legals or whatever upfront. But obviously we need a certain minimum volume to recover some of the onboarding costs, let's say, plus anything else. So we start as of 5 million total volume, we can go up to 100. So it's more a lower limit than that.
Yeah, okay. Meaning, since you mentioned it, the DD process is entirely done within the team. So you don't
No, it's
outsource.
not. It's not. But if we need third-party experts, we don't charge.
Okay, that
assume
is
the
your
cost
cost,
upfront.
so to say. That's
Yes.
from, okay.
Yes.
Yeah, that's also very good to know, I think. With Grand Perspective, we've looked at the company that is selling hardware. In the INAM context, we often have companies that require hardware to produce their materials. Have you had cases like these where we're actually financing production?
We can.
Machinery, let's say.
But the thing is, there needs to be some revenue generating elements. So for example, what I've looked at is a 3D printing company which has customers who cannot afford a full printing or a full printing services contract, but and they have like 3 of their own printers in their own workshop generating pieces for customers. Those I can fund. But if it is production assets being used to manufacture components, which then be used to do something else. Because the further away it is from market and revenues, the more difficult it becomes for me.
Okay.
Because the more I need to rely on the equity position of the company. And for example, what doesn't work, I can give you the other example. What doesn't work is if you want a 5-year contract from me, and you say, well, I'm going to generate revenues via commercials. Some do that, right? I have a commercial screen on which I sell space for commercials. The thing is, a long-running commercial is 30 days, and then I just cannot be convinced that if you say, well, but I'm going to generate a lot of business, and say, yeah, but every time after 30 days, the revenue is at risk. And I cannot have a 5-year contract refinanced in 30-day installments. That's just too much. What I can do is that if there is a 5-year contract which has an initial, let's say 2 or 3 years behind it, and when I'm convinced that it's a really sticky business model and that there is a good renewal rate behind it for which there needs to be some precedent, actually, so it's not going to be a startup, new business something, then I can do that. But the difference between my leasing period and the customer rental period needs to be as small as possible. Ideally, the customer rental agreement is longer than the leasing period. But as I said, if it's really sticky, like for example, at Grand Perspective, they're never going to get rid of it again once it works, because it gives them security, because authorities like it, because insurance premiums can go down, everything else. Then there is some flexibility.
And venture capitalists probably also like it.
Yes, they do. Yes, they do.
Yeah, absolutely. Tara, could I ask you to check if there's any more questions from the...
There's 2 questions in total. First one is from Christoph. Are there cases where you finance a company's own assets used to produce a different product? I think
more or less, I think we covered that.
Yeah.
And the second question is, does Kineo have a use case for the operation of a first full-scale chemical production unit in customer's refinery?
Not sure I understand that. So meaning a production asset.
Glenn, could you come on stage, unmute your mic, and I think we should be able to hear you.
I can come on virtually. Can everybody hear me all right?
Yes.
Yes, we hear you well.
Sorry, I didn't manage.
Get that question.
Yeah, I was trying to be very brief in a very small text box. So essentially, we're putting together a project in the south of the Netherlands to deliver our first full-scale production unit. We will have offtakes from 3 or 4 major organizations. And I was just interested to know if you've ever funded that type of asset. Does that help?
Yeah, so it's a production plant, and
Yes.
which will produce things which will then be bought by customers, or which will produce parts.
Absolutely. No, it will produce distillates or products that companies will then buy and use to make final products.
I think it depends on the stability of the revenue stream behind it. So that's probably something where we wait for the first, let's say, 6 to 8 months and see how it develops, and whether it can actually generate a stable revenue stream if you're selling off small parts. And if that can be done, then yes, that's a project we would look at.
So we're typically going to have contracts in place before we start from 3 to 4 corporate refiners, because we're going to need those in place to be able to raise finance. And so because I like the bit that you're saying you're talking to people early. That's clearly what we're going to have to do. So yeah, I was intrigued to. Maybe we take that one offline.
Yeah, well, I need more information, quite honestly.
Absolutely, that doesn't surprise me. Okay, but yes, maybe is a good start.
Yes, maybe is a good start for more information. I agree.
I'm happy to connect you after the event, of course.
Thank you.
Thanks, Ben.
Then we have one more from Michael. Michael, would you like to unmute and just ask? I think it's just more organic that way.
Certainly. Similar question, it might have been answered in parts, but it's a very particular case study. And this involves a chemical startup, and we're looking for 500,000 euros of capital investment for operational leasing of production equipment. So here we're looking at the production equipment will be formulation robotics, and the company would have a direct sales revenue stream based on the formulations which are being put together on these robots. Is that something that would fall under your fundable portfolio?
Yes, but if that was the only thing you needed, it would be too small, admittedly. So as I said, I start as of a total expected volume of 5 million. So if it was just a one-off 500K.
Right, so this is the start. Oh, right, this is a bit I missed. Thank you.
Yeah. So
aim high, Michael,
Sorry.
Maybe a year or two later down the line. Thank you,
Yes,
though.
definitely.
That's it.
Okay.
In the chat, at least.
Yeah, I would have a couple of other questions if you still have a minute or so or two. And when we talk about warrants, can you give us some examples? Is it the typical stuff that you'd also put into a venture debt contract, or are there any specificities in your particular, or is it very, very individualized?
It is individualized. What we normally do is we take a fraction of a percentage per used million.
Mm-hmm.
So it's, I can't remember your contract. Is it 0.2? Something like that. It's a fraction. Yeah. It's a fraction. So let's say it depends on the interest rate as well, as I said before. So it's a fraction, and if I do like a 10 million volume and I get a fraction of a percentage for each million used, then I end up between 1 or 2% of the equity. Mm-hmm. And then there are certain terms and conditions on when I'm allowed to execute on them. And normally the company always has the right to just redeem it in cash as well. Okay. So we're not pushing ourselves in the equity at all costs. Mm-hmm. But as I said, then there's a higher interest rate, can't be done contracts without equity component as well. For example, I have one business which is basically family owned, and they were just adamant. They just said, we don't want anybody in our equity, thank you very much, which is why we're talking to you in the first place, because we're not interested in any capital increase. I can do that as well. So I don't walk away from a good deal just because somebody doesn't look right.
Okay.
That's probably the answer.
Covenants, do you also work with them? Like
Not really. So it's one of the major advantages to other debt, I think. Yeah. So what we do, we have basically two main securities. One is the asset, which we bought, which we own, and which we give back after the leasing period. And the second one is the associated revenue stream. So in an ideal world, obviously the asset being at the customer side is generating an income, right, for the company, and a fraction of that income is due to us for redemption of the loan plus interest, and that associated revenue stream is pledged to us so that we can access our portion of that revenue in case of insolvency. That's the only reason why we should ever approach it. So it's a silent pledge. Customers don't need to know, don't have to be informed about it, and that's pretty much it. So current account is free, IP is free. We have a use license, but it's not a pledge on IP. And no, there's nothing else in terms of securities. We try to be as venture compatible as possible.
Sounds like a quite good option for many cases, I think. Although admittedly, the 5 million, is something, as I said initially, we work with startups that are very early, but also some that are further down the line. If I take an example of one of our biggest startup members, they did a 170 million round last year for recycling plants, essentially, with high-tech chemical equipment in there. So that would also be something that, firstly the size, but also the plant as such, which is generating revenues, obviously, because they're taking materials on and sell the constituents. That is also something that could potentially fall within your.
Well, from my point of view, yes. From their point of view, they might actually move on towards other sources. They might be able to issue a bond.
I mean,
So
let's say,
they might have
had they not done their round yet, they could have.
But at a certain point in time, companies outgrow us, and then they become bankable. And then if you have access to bank loan, then by all means, it's more attractive at that point in time.
But regarding the 5 million you mentioned, maybe there's a misunderstanding. It does not mean that I have to use this financing volume right now. In our case, it is expected to be our customer volume. Let's say this is the number of hardware sales, you can say, we are going as a service, of course. We are going to generate over the next years, and of course we are going to reach these 5 million.
Quite easily. Actually, I think we have a bigger volume, but it's over many years. It's not on a per case basis. Maybe that was a misunderstanding, but it's total partnership volume. Let's say, for the entire thing.
Yeah, I think that makes it indeed a bit clearer. Have you got more questions?
Which is very great, isn't it?
Absolutely.
Also, if you talk to VC investors also to some point, and you can say, okay, from the first beginning, the hardware is covered for the next years up to a volume of 5.7 million or much. This is absolutely good.
Sounds good.
Nothing else for me.
Okay, last chance for everybody, perhaps also in the room. There's a question here.
I think there is a similarity between taking accounts receivable in accounts and taking hardware into accounts, between factoring and asset-backed securities.
Well, we're not factoring, right? Factoring is
not finished. And I recognize that a factoring company will dilute the contract if the customer growth is too fast. They can manage it as a fell in bankruptcy if they would continue working with the customer who is working too fast. Is this similar to asset-backed securities, or is your fast-growing customer well accepted?
Yes.
Okay.
Yes, we don't mind fast growth. Actually, we quite like that, to be honest, because then we deploy capital at a faster rate. I think we're different in that respect. That normally the end customers of our companies are blue chip companies. That's one. So I mean, a Siemens or whatever, an E.ON is not going to go bankrupt anytime soon. And if they do, we've got other problems anyway. The other thing is that we only grow with the business once there is a paying customer. So, and it's normally long-term arrangements. So no, I don't mind. I refinance 100% of the deployed assets, and I can do 10 customers per year, or I can do 2, I grow with the business. So that's fine. And factoring as well. Factoring normally adds a discount, right? Factoring says, well, I buy 80 cents on the dollar or something in terms of buying. We don't. We don't. So we buy all of it.
Thanks.
Any more questions from the room here at Berlin Partner? No, I think we've covered everything. So, well, there's one thing. How do you think will the changing interest environment that we will be seeing impact on your? Will that be enabling more business to?
I don't think. I quite honestly, I think the hype on changing interest rates is overrated. We have an 8% inflation right now, and currently, so for my 100 euros today is going to be 92 by the end of the year. And if then I give this to, let's say I give Dr. Lindner a loan, right, and he's giving me 1%. So instead of 92 at year end, I'm going to have 93 at year end. It's not going to change my world, right? So no, short answer. It's we're far, far away from that being or having an impact, really.
No, that's quite positive, you know, considering all the bad news we hear about on this topic.
I think venture capital in general is not going to be impacted much, at least not for the next 2 or 3 years. There's just so much money still around.
Yeah.
I think it's not very much is going to change, at least not shorter.
Yeah. 2 or 3 years in the venture capital world is an eternity in a way.
Yes.
Super. Then I think I'm closing it here. Thank you very, very much, Kreske. Thank you very much, Alexander. It's been a pleasure, and it's been extremely informative having you here. And you know, I've set up the connection with Glenn from Low Sulfur Fuel, a company that has actually taken part in our ATMACOM in early May, and we'll see whether that is of help to you or at plan. Well, thanks a lot again, and have a good evening, everybody.
Thanks a lot.
Thank you.